This is the Weekly Outlook here at XM.com. I'm Christina Marujos, and joining me today is Senior Investment Analyst Mario Hadjikyriacos to have a look at this upcoming week. And with 3 central bank meetings, a lot of rate hike bets, and crucial U.S. data, I think this week is set to give investors a lot to focus on. Starting now with the Bank of England, it meets on Thursday. It's widely expected to raise interest rates. Therefore, what could that mean for the pound?
Hello, Christina. It's definitely going to be a very exciting week for the pound. So the Bank of England is widely expected to raise interest rates. The implied probability in the markets is around 90%. So it looks like a done deal. The economy is pretty good. Inflation is hot. Labor market is strong. Wages are firing up. And the Omicron wave didn't hit the economy quite as hard as many feared. So they'll probably raise interest rates. Now, I think the real question for the pound, though, will be, will they also begin to shrink their balance sheet? So last summer, the Bank of England told us essentially that after they raise rates a couple of times, they would stop reinvesting all the bonds they bought so far. So once a bond comes for matures, they won't reinvest it anymore. They will allow it to roll off the balance sheet, which essentially means they are going to be shrinking their balance sheet over time. Now, if they do that, that would be great news for the pound, essentially, because it argues for higher UK yields over time. And if UK yields are going higher, then that could allow the pound to widen its interest rate advantage. So if we get both the rate hike and quantitative tightening beginning, then it could be a very solid week for the pound.
And speaking of raising rates, we had a very hawkish Fed earlier this week, and money markets are now pricing in almost 5 rate hikes for 2022, putting thus the wind back into the dollar sales. On Friday, though, we have the crucial U.S. employment report. Could it further support the greenback?
Well, that's very probable. So it's not, the employment, the nonfarm payrolls number is not expected to be great. It's around, the forecast is around 200,000. That seems low compared to the prints that we got last year, but it's quite natural for jobs growth to slow down as the economy approaches full employment. Now, in fact, I think that the markets are going to focus most on wages, right? Because right now the worry is inflation. And when the Fed looks at inflation, well, essentially they fear a wage price spiral, right? They are afraid of a spiral whereby rising inflation leads to rising wages, and we enter a vicious sort of inflationary spiral. Therefore, at this point in the cycle, wage growth is probably more important than jobs growth. Now, in the markets, you're right, we almost have 5 rate increases by the Fed priced in for this year. And if we get a solid employment report with wages crucially accelerating, I think that could solidify that pricing. The markets could fully price in the 5th rate hike, and that could give the dollar a little bit more juice.
Crossing into Europe now, the European Central Bank meets on Thursday, and this meeting is unlikely to have any surprises in store for us, but money markets still price in a small rate hike for this year. Therefore, is the euro in for a disappointment?
Well, most probably, but maybe not on the meeting. So let me explain. The European economy is not doing that great. Growth is very slow. The labor market is still not that great. Wages are pretty subdued. So even though inflation is high right now, the ECB looks at the whole situation and thinks, yeah, it's probably not going to stay that way because the wage pressure is just not there, at least not yet. Now, we had some encouraging signs lately about wages, but nothing spectacular, nothing that will make the ECB suddenly signal that rate hikes are coming. Now, that's in contrast to the markets. The markets are almost pricing in a full rate increase before the year ends by the European Central Bank. I think that's quite unrealistic considering where the economy is right now. It's quite unlikely they're going to raise interest rates. So that leaves some scope for disappointment. in the euro overall. Therefore, I think the outlook is still negative, and the euro will also have to weigh political risks. We have the possibility of an early election in Italy. The French presidential election is coming up, and of course, the tensions in Eastern Europe, the geopolitical tensions around Ukraine, are not cooling off. So, overall, I would argue that the outlook for the euro remains negative.
And finally, let's look at the Reserve Bank of Australia meeting, where policymakers might try to dampen hopes of a rate hike. Therefore, what could that mean for the Aussie?
That actually will be a very interesting meeting, because the Australian economy is actually doing pretty well. So growth has been relatively strong. The labor market is now actually stronger than it was pre-crisis, and inflation is starting to fire up. So all of that argues, all of that is good news really for the Reserve Bank, but it's not all good news. So the latest PMIs suggested, the latest business surveys, those suggested that economic growth took a hit from the Omicron outbreak, and at the same time, you have the risk of the slowdown in China spilling over into Australia, given their close trading relationship. So I think the RBA is going to be relatively neutral. And if anything, I think they'll try to push back against market expectations. The markets right now are pricing in 5 rate increases before the year ends. And the latest guidance by the Reserve Bank was that they won't raise interest rates this year. So there's a mismatch there. And I believe that policymakers are going to try to, let's say, massage market expectations, to dampen rate hike bets a little bit. If they do that, it will probably be bad news for the Aussie.
Marios, it was great having you with me today. This was the Weekly Outlook here at xm.com.